Welcome. Today we're diving into the circular flow model, a fundamental concept in economics that helps us visualize how money moves through an economy. Imagine a system where money is constantly circulating between different groups, never really stopping. This model is a powerful tool for understanding the relationships between households, businesses, governments, and even foreign markets. By the end of this video, you'll see how these flows shape the overall health of a nation's economy and why economists rely on this model to analyze economic activity. Let's start by defining what the circular flow model is and why it matters. Circular flow model is a simplified representation of how money and resources move in an economy. At its core, it shows the endless movement of money from producers to households and back again. Producers pay workers wages, and those workers spend their earnings on goods and services, sending money right back to the producers. This continuous loop is what keeps the economy running. While the basic model focuses on just two groups, households and businesses, real economies are more complex, involving additional sectors and flows. Understanding this model is the first step to grasping how economies function. So why is the circular flow model important? It helps us see the big picture of economic activity. By tracking how money moves, we can better understand the connections between different sectors and how changes in one area can ripple throughout the entire economy. For example, if households start spending less, businesses might produce less, leading to fewer jobs and lower incomes. Policymakers use this model to make decisions about taxes, spending, and interest rates, aiming to keep the economy healthy and growing. It's a foundational tool for anyone interested in economics. Start with the simplest version, the two-sector model. Here we have households and businesses. Households provide labor to businesses and receive wages in return. They then use those wages to buy goods and services from businesses. This creates a continuous loop of money and resources. The two-sector model is a great starting point for understanding the basics, but real economies involve more players and more complex flows. Still, this simple version lays the groundwork for everything else. As we move beyond the basic model, economists add more sectors to better reflect reality. The three-sector model introduces the government, which collects taxes and provides public services. The four-sector model adds the foreign sector, accounting for exports and imports. Finally, the five-sector model includes the financial sector, representing banks and investment flows. Each additional sector adds complexity and helps us see how interconnected the economy truly is. These models help economists and policymakers analyze the impact of changes in one sector on the entire system. Household sector is where it all begins. Households supply labor and skills to businesses, and in return earn wages, salaries, and other income. They use this income to buy goods and services, pay taxes, and save for the future. Households are also consumers of government programs and services. Their spending decisions have a direct impact on business revenues, and ultimately the health of the economy. Understanding the role of households is key to grasping the circular flow model. Businesses are the producers in the circular flow model. They hire workers, pay wages, and use resources to create goods and services. The money businesses receive from selling products goes back into paying employees, buying materials, and covering other costs. Profits are either reinvested or distributed to owners and shareholders. The business sector is essential for generating jobs and driving economic growth. Its interactions with households, governments, and other sectors keep the economy moving. Government sector plays a crucial part in the circular flow model. It collects taxes from households and businesses and uses that money to fund public services and programs such as education, healthcare, and infrastructure. Government spending injects money into the economy, supporting both households and businesses. At the same time, taxes act as a leakage, reducing the amount of money circulating. The balance between government spending and taxation can significantly influence economic activity. Foreign sector represents the rest of the world. It comes into play when a country trades goods and services internationally. Exports bring money into the economy while imports send money out. This sector highlights the global nature of modern economies and shows how international trade can affect domestic economic health. A country with strong exports can boost its income, while heavy imports can lead to money leaving the system. The foreign sector adds another layer of complexity to the circular flow model. Financial sector includes banks, investment firms, and other financial institutions. It provides loans and investment capital to businesses and households, helping fuel economic activity. Savings deposited in banks can be lent out to others, creating a flow of funds that supports spending and investment. The financial sector also channels money from investors to businesses, enabling growth and innovation. Its role in the circular flow model is to keep money moving efficiently throughout the economy. The circular flow model, not all money stays within the loop. Injections are sources of money entering the economy, such as government spending, exports, and investments. Leakages are ways money leaves the system, like taxes, imports, and savings. The balance between injections and leakages determines whether the economy grows or shrinks. If injections exceed leakages, the economy expands. If leakages are greater, the economy contracts. Understanding these flows is crucial for managing economic stability. Gross domestic product, or GDP, is a key measure of a country's economic health. It's calculated by adding up consumer spending, government spending, business investment, and the net value of exports minus imports. The formula looks like this: GDP equals C plus G plus I plus XM. Changes in any of these components can influence the overall size of the economy. For example, if households spend less or if exports drop, GDP will decrease. Policymakers watch these numbers closely to guide economic decisions. GDP is often used as a snapshot of a nation's economic health. When GDP rises, it usually means the economy is growing, more people are working, and businesses are thriving. When GDP falls for 2 consecutive quarters, it's commonly considered a recession. Governments and central banks use GDP trends to decide when to adjust fiscal and monetary policies, like changing tax rates or interest rates, to stimulate growth or cool down inflation. Monitoring GDP helps keep the economy on track. Let's look at a real-world example using Apple. Imagine Apple employees and customers. Employees provide labor and receive wages from Apple. They spend some of that income on Apple products, sending money back to the company. Both employees and Apple pay taxes to the government, which then uses those funds for public services. Apple may also receive government subsidies or benefit from infrastructure projects. This example shows how money flows between households, businesses, and government, illustrating the circular flow model in action. Apple is an international company, so the model gets even more complex. Investors may put money into Apple expecting returns. Apple sells products worldwide, bringing in money from exports. At the same time, it may import components from other countries, sending money out. These additional flows show how interconnected modern economies are and how the circular flow model adapts to include more sectors and transactions. Let's break it down for a 5-year-old. Imagine you walk your neighbor's dog and earn $5. You use that money to buy a treat at the store. The store owner uses your money to buy supplies or pay workers. Your neighbor can go to work because you walk the dog, and their employer benefits from their labor. Money keeps moving from one person to another, helping everyone along the way. That's the circular flow model in its simplest form. One interesting thing about the circular flow model is that it doesn't have a true ending. The cycle keeps going as long as people work, earn, spend, and invest. The model simply describes the current state of the economy and helps us see where money is coming from and where it's going. Policymakers use this information to make decisions about taxes, spending, and trade to keep the economy balanced and healthy. Why is it called the circular flow model? Because money moves in a circle. Households spend money, businesses use that money to make new products and then pay households for their work. When you add in governments, investors, and foreign markets, the circle just gets bigger and more complex. But at its core, it's all about the continuous movement of money and resources. While the circular flow model is a great tool, it does have its limitations. It shows where money is now, but it doesn't always predict how changes in one area will affect the rest. For example, if unemployment rises by 5%, the model can't tell us exactly how much less people will spend or how much tax revenue will drop. It's a snapshot, not a forecasting tool. Economists use other models and data to make more precise predictions. Today's global economy is more interconnected than ever. The circular flow model helps us see how resources and money move not just within a country, but across borders. International trade, investment, and financial flows all play a role in shaping economic outcomes. Understanding these connections is essential for making sense of economic news and trends in our increasingly globalized world. Governments and central banks use the circular flow model to guide their economic policies. By analyzing how money moves between sectors, they can adjust taxes, spending, and interest rates to influence growth, employment, and inflation. For example, increasing government spending can inject more money into the economy, while raising taxes can slow things down. The model provides a framework for making informed policy decisions. Circular flow model isn't just a classroom concept, it's used in real-world economic analysis. Businesses use it to plan investments and predict demand. Governments rely on it to design budgets and forecast tax revenues. Investors look at the model to understand market trends and risks. By mapping out the flow of money, everyone from policymakers to business leaders can make better decisions. Change in one sector can have ripple effects throughout the entire economy. For example, if the government raises taxes, households have less money to spend, which can reduce business revenues and slow economic growth. Similarly, a surge in exports can boost incomes and create jobs. The circular flow model helps us understand these cause and effect relationships and anticipate the impact of policy changes. For an economy to remain stable, injections and leakages must be balanced. If too much money leaks out through taxes, savings, or imports, the economy can shrink. If injections from government spending, investment, or exports are strong, the economy can grow. Policymakers monitor these flows closely to maintain economic stability and promote sustainable growth. See the circular flow model in action. Imagine a new government program increases spending on infrastructure. This creates jobs, boosting household incomes. Those households spend more, increasing business revenues. Businesses hire more workers and invest in new equipment, further stimulating the economy. This positive cycle continues as long as injections outweigh leakages, demonstrating the power of the circular flow model. Governments track national income by monitoring all the injections and leakages in the economy. This helps them calculate GDP and assess the overall health of the nation. By understanding where money is coming from and where it's going, policymakers can identify potential problems and take action to keep the economy on track. Accurate tracking is essential for effective economic management. The circular flow slows down, say, due to falling consumer spending or reduced business investment, the economy can enter a recession. Policymakers respond by increasing government spending or cutting interest rates to stimulate activity. The circular flow model helps explain why these actions are necessary and how they can help restore growth. It's a valuable tool for understanding economic cycles. While the circular flow model is useful, it's important to remember its limitations. It doesn't capture every detail of the real world, such as informal economic activity or the impact of technological change. Still, it provides a clear framework for thinking about how money moves and how different sectors interact. Economists use it alongside other tools to get a complete picture of the economy. Wrap up, the circular flow model is a foundational concept in economics that helps us understand how money and resources move through an economy. By tracking the flows between households, businesses, governments, investors, and foreign markets, we can see how interconnected everything is. The model highlights the importance of balancing injections and leakages to maintain economic stability. While it has its limits, the circular flow model remains a powerful tool for analyzing and managing economic activity.